It's a deflation warning as prices are about to crash. I'm your host, Steven Van Metre, and thanks for joining me today. With investors positioned for inflation and consumers expecting prices to go higher, there's mounting evidence that the opposite's about to happen. Let's head over to Bloomberg where we kick off this story, who headlined that the LA port sees a chance to ease ship backlog by the summer peak as retailers intend to restock in the second quarter. Most retailers continue to tell me they'll use quarter two to replenish inventory, get that safety stock at a more comfortable level. According to Bloomberg Television, then we'll have a chance, if we hit these two marks properly, to pivot into an earlier than normal peak season in early June or July. But there's little evidence to suggest that they're going to need to be restocking the second quarter, as retailer inventories here shown by the St. Louis Fed database, jumped last month as we've seen before, and are likely to head higher without fiscal or monetary stimulus to support the economy. At the Port of Long Beach, together with the Los Angeles port, handle 40% of seabound imports, according to the executive director there, was less optimistic on the outlook. We'll be hard-pressed to see more than small gains until perhaps the fall, according to Cordero. We need to recognize that the supply chain isn't so elastic that it can easily handle historic jumps in volume. In his interview, he predicted upcoming labor negotiations between dock workers taking place between the International Longshore and Warehouse Union representing them and the Pacific Maritime Association representing port operators and shipping lines would go smoothly and not cause disruption. I'm optimistic you've got professionals on both sides of the table. These dock workers need to get paid what they're worth, he said, and I think everyone understands what's at stake here. And this is normal when you see periods of high inflation, particularly when workers are being asked to do even more. And we know there's a big backlog at the ports of Los Angeles and Long Beach, and they're in every right to ask for those higher wages. And all that will do is continue to build the inflation story. But how that leads to deflation, you might wonder. Well, let's continue on. As we see, there are early signs of improvement. As of late Tuesday, the number of container carriers in the official queue to enter the twin ports of Los Angeles and Long Beach totaled 78, the lowest level since November, and down from a peak of 109 a month ago, according to the Maritime Exchange of Southern California. Sea Intelligence, a Copenhagen-based maritime data and advisory firm, released a report recently suggesting it could take 8 to 9 months to iron out the disruptions causing record low reliability in container shipping. The National Retail Federation issued a statement saying imports to the nation's congested ports are expected to grow modestly during the first half, but continued high volumes will keep pressures on supply chains. And of course, supply chains is the issue here, but perhaps all of these imports are going to lead to much lower prices. Now, let me show you here, because we've got the trade balance in goods and services in blue, and you'll notice this is a trade deficit. So when we're importing more than we're exporting, which is very common in the United States, when it hits extreme levels, I want you to notice that the CPI here in red. Now, I know you're saying, well, wait a minute. It looks like it's trending higher as these imports and the trade balance is at really low levels. Got to remember, the CPI is a lagging index, and notice what happens when the economy gets flooded with all these imports. The CPI goes down, and we see that happen over here. As the imports started coming in, CPI went lower, and now everyone believes the CPI is going to head higher as we're seeing a record trade imbalance. Of course, that suggests that the CPI is indeed headed lower, and there's more evidence because the University of Michigan Consumer Sentiment Survey against the advanced retail sales data on a year-over-year basis suggests that consumers can't afford these higher prices, and ultimately, if they reject them, that means, of course, prices will come down. And here you can see going into the dot-com bubble, the sentiment went down and year-over-year rate of change on the retail sales decreased. Here in the dot-com bubble, again, recession's great solution for dealing with inflation because people just don't have the money to buy. And without, again, fiscal and monetary stimulus, we can anticipate that the University of Michigan is correctly anticipating that retail sales will fall. And if you remember from a show just the other day where we talked about the retail sales data, remember the unadjusted data was negative and steeply negative, suggesting that if we continue to get negative prints on the unadjusted data in the months to come, that what we're going to see is that seasonally adjusted data go way down. But let's continue on, because it's also a story of the equity markets. And now the stock markets are not making new all-time highs anymore, and that has a direct impact on people's spending. Remember, Alan Greenspan coined the term the wealth effect, and saying that high asset prices lead to high demand. And here you can see in blue the NASDAQ 100 going down and the year-over-year rate of change of retail sales going down. In the great financial crisis, NASDAQ goes down, as too does of course, retail sales, and now we've seen the stock market peak and go down, and that just tells us that as the equity markets go down, people feel less rich because they are, and they tend to spend less. Of course, with all these goods coming in out of the ports of Los Angeles and Long Beach into stores, that's going to pile up. What does that tell you? Of course, that's going to happen to prices. They're going to head lower. Let's continue on with the story, because even the Fed gets involved as the official says monetary policy needs substantial adjustment. The Chicago Fed President Charles Evans suggests inflation pressures could still diminish. Wait a minute. How the Fed was worried about this, reducing the need for more restrictive steps. The current stance of monetary policy is wrong-footed and needs substantial adjustment. Well, there's no doubt about that, as Chicago Fed President Charles Evans said at a monetary policy conference in New York. But how big will it need to be? Well, the real question is, Charles, is that monetary policy was not intended to deal with pandemic and supply chain related issues. It wasn't never designed for that. And so, of course, perhaps need to rewrite the books, but let's continue on. The answer will rest on what happens with inflation this year, he said. And Mr. Evans said that one model of inflation presumes that price pressures should diminish this year if they're due to what he calls markup shocks. And that's just simply when retailers mark prices up too high. Well, consumers reject them, as I've said, will happen. And that relatively short-lived. It would be more troubling, he said, if higher inflation resulting from what he described as persistent technological disruptions. Traditionally, high inflation has forced the Fed to tighten monetary policy to restrictive settings that hasten employment losses and recessions. Mr. Evans made a distinction between short-term or cyclical changes in inflation over the course of an expansion and underlying inflation. In these past episodes, restrictive policy was required because underlying inflation was too high, and cyclical inflation might lead to prices to even rise even higher. Of course, what we know is the Fed has a perfect track record, a flawless track record of crashing the economy when it pulls back and begins into a tightening cycle. And if you're concerned about that with your portfolio, well, you shouldn't be. Be sure to check out Portfolio Shield. There's a link up in the corner in the description below. You'll be glad you did. Let's continue on with the story, because Mr. Evans said the underlying inflation still appeared to be well anchored at levels consistent with the Fed's 2% target. Wow. Well, I don't know what he's looking at, but CBI is at 7. Unlike in the 1980s and 90s, the current situation is likely to require less ultimate financial restrictiveness, which will pose a smaller risk that the Fed forces higher levels of joblessness and potentially a recession in the past. And let's just put it this way. They are hoping they don't crash everything. But the reality is they're going to. And as I mentioned in the show yesterday, the best way to deal with inflation is to pop asset bubbles, because that will curtail spending in a big way and get that inflation number down. It just so happens, while that may not be the Fed's intent, it generally is the actual outcome. Let's continue on. Where we see even more evidence of deflation, we're heading over to the Philly Fed Manufacturing Business Outlook survey for this month. And note delivery times went from 25.2 to 23. But it's not that we're really interested in. It's a 6 months from now that they're predicting the delivery times are going to go way down to a negative diffusion number of minus 22. And what does that mean? Well, it just means when they produce something and the delivery time it takes to get somewhere, well, that adds into the cost. As soon as you can get it out of the factory and to the final destination to sell, well, that helps reduce inflation down. Well, check this out, because I pulled a chart for you out of the Fred database showing the current delivery time, this from the Philadelphia district, against consumer price index. And what I want to show you is that when current delivery time declines, notice that inflation follows lower shortly thereafter. And here's a great example. In the 80s, we see the delivery times went down, inflation fell. Here's another example. In the early 90s, we see the delivery times going down, inflation, again, lagging indicator, so it's going to follow. And there's a number of other spots in here that you could pull this chart yourself and look. And now, all of a sudden, you see, well, wait a second, Steve, you said this is way up here. It's got to go down. You're right. Let's check out the chart for 6 months from now, and delivery times are forecasted to tank. And with that, we'll bring inflation and prices down. And now you understand why this is really a story of deflation, and what the Fed's doing with its policy is a wrong move at the wrong time, and likely will have the same outcome it has had 100% of the times before, of popping the stock market bubble and hopefully, if they're lucky, not creating a financial crisis in the process. But we'll soon find out what sort of rot lies under the economy as asset prices start to unwind. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. I appreciate you. Bye now. The content of this video provides educational information only. It's not intended to provide investment or other advice. It will have to be construed as recreational solicitation by selling securities, financial instrument, or participate in any particular trading strategy. This video was prepared by Steve Van Metre. Personal capacity. Opinions expressed in this video that do not affect the Atlas Financial Advising or Steven Van Metre Financial.